Did you know that 80% of individual investors fail to beat the market? That's right, most people who try to invest end up losing money in the long run. But here's the crazy part. It's not because they're bad at math or don't understand stocks. It's often because they get stuck in a loop of confusing, irrational decisions. And that's exactly where Bertrand Russell's Barber Paradox comes in. You might be wondering, what does a philosophical riddle have to do with investing? Well, the Barber Paradox shows how we can get trapped by contradictory logic. The same thing happens in the stock market when investors make decisions based on conflicting data or emotions. In this video, we'll break down this paradox and show you how it connects to value investing. You'll learn how to avoid circular reasoning, overcome analysis paralysis, and find value in places that most investors overlook. Stick around, because the next few minutes could completely change your approach to investing. Chapter 1. The Barber's Dilemma. A value investing paradox? You've probably heard of Bertrand Russell's Barber Paradox, but have you ever wondered how it ties into value investing? The Barber Paradox goes like this. There's a barber in a town who shaves only those men who do not shave themselves. The question is, who shaves the barber? If the barber shaves himself, then by the rules, he shouldn't shave himself. But if he doesn't shave himself, then he should be shaving himself. It's a never-ending loop. At first glance, this might seem irrelevant to investing. But in reality, the paradox mirrors a situation investors often face: contradictory data or logic that seems impossible to solve. Value investors face these paradoxes all the time. One of the best-known paradoxes for value investors is trying to decide whether a stock is undervalued or simply in a downtrend. The market's logic can be just as tricky as the barber's dilemma. In value investing, the challenge is separating your emotions from the decision. A stock might look undervalued based on earnings, but if the market's overall sentiment is negative, the price may continue to fall. It's like the barber's paradox, where the logic keeps circling back and forth, never offering a clear answer. Successful investors know how to break free of this cycle and make decisions that go against the crowd. This is why great value investors, like Warren Buffett, emphasize the importance of a long-term mindset. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." Staying patient and trusting your research is key to solving your own Barber Paradox in investing. Chapter 2. Self-reflection in investing. Shaving off your ego. One of the most important lessons value investors can learn from the Barber Paradox is the value of self-reflection. The paradox shows how logic and reasoning can easily become clouded by emotions. Similarly, investors often face the challenge of making decisions that don't align with their gut feelings. The key is to detach your emotions from the decision-making process. The idea of shaving off your ego can be a game-changer for investors. One of the most damaging things an investor can do is hold on to a losing position because of pride. It's natural to want to believe that your initial analysis was correct, but holding on too long to a bad investment is like the barber refusing to acknowledge that his logic doesn't work. In a 2019 study from Dalbar, a financial services research firm, it was found that the average investor underperformed the market by about 4% annually over the past 30 years. Why? Because they let emotions control their investment decisions. Fear and greed caused them to sell low and buy high. Like the barber who can't escape the paradox, investors who fail to separate their ego from their portfolio can end up caught in the same cycle. To avoid falling into this trap, value investors must learn to accept when their decisions are wrong. The best investors, like Charlie Munger, often talk about the importance of learning from mistakes. Munger said, "The best thing a human being can do is to help another human being know more." Learning from your mistakes and focusing on facts rather than feelings is the essence of successful value investing. If you're enjoying this, don't forget to subscribe and hit the bell icon to stay updated on all our value investing insights. Chapter 3. The Paradox of Overthinking. Is more information always better? One of the most common mistakes in investing is overthinking. Like the barber's paradox, this can lead to an endless loop of analysis without any clear outcome. In the age of information overload, it's tempting to dive deeper and deeper into financial reports, news, and trends. But is more information always better? The truth is, overanalyzing can sometimes paralyze decision-making. A 2020 study from Vanguard found that investors who make fewer, more deliberate decisions tend to perform better in the long run. In contrast, those who make too many moves based on short-term market fluctuations often see lower returns. In value investing, the key is not to focus on every bit of data but on what truly matters. The Barber Paradox is a great reminder that sometimes, the more you think about something, the more confused you get. Focus on fundamental analysis, and avoid being distracted by every minor fluctuation in the market. Ask yourself, what's the long-term potential of this company? What's the real value? Warren Buffett, again, offers wise advice here. He once said, "The most important thing to do if you find yourself in a hole is to stop digging." If you feel like you're falling into a loop of overanalysis, it might be time to step back. The market is full of noise, but focusing on the core principles of value investing, such as a company's earnings, debt levels, and management quality, can help you see through the confusion. Understanding the Barber Paradox in this way helps investors avoid the trap of analysis paralysis. By simplifying your decision-making process and sticking to the basics, you'll be able to make more confident, clear choices in the world of value investing. It's not about knowing everything, it's about knowing the right things. If you're learning something new, make sure to like and subscribe. We've got more valuable tips coming your way. Chapter 4. Circular Logic in Stock Valuation. The Barber's Mirror Effect. When it comes to stock valuation, one of the biggest challenges is avoiding circular reasoning. This happens when the logic you use to assess a stock leads you back to where you started. The Barber Paradox is an excellent analogy here. Just like the barber's logic keeps looping back, stock valuations can sometimes end up in a cycle that doesn't offer clear answers. One example of this circular logic in investing is the tendency to rely on market sentiment to determine a company's value. Market sentiment, however, often depends on the company's stock price, which in turn is influenced by the sentiment. This loop makes it tough to assess whether the stock is undervalued or if it's just stuck in a downward spiral. A study published by the Journal of Finance in 2018 found that nearly 75% of stock price movements in the short term were driven by sentiment rather than actual fundamentals. This means that prices may not always reflect a company's true value, creating a paradoxical situation for value investors. To avoid this circular reasoning, value investors should focus on the fundamentals. Look at a company's earnings, debt levels, and growth potential. Take a step back from the daily price fluctuations and focus on the long-term health of the business. As famed investor Benjamin Graham said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." The value of a company doesn't change based on market mood swings but on its intrinsic worth. By cutting through the cycle of sentiment-driven valuation, you can make clearer, more rational decisions. Just like solving the Barber Paradox, recognizing circular logic and breaking free from it can unlock a clearer path to profitable investing. Chapter 5. Investing in the non-barbers, finding value in the unconventional. One of the key strategies in value investing is finding stocks that others have overlooked. These stocks are like the non-barbers in Bertrand Russell's paradox, unconventional, misunderstood, or undervalued, but with hidden potential. While the majority of investors flock to popular stocks, savvy value investors focus on the underappreciated opportunities that others miss. In 2020, a study by Fidelity revealed that small-cap stocks outperformed large-cap stocks by 13% over a 10-year period. Small companies often have less analyst coverage and are overlooked by the masses, creating the perfect environment for value investors to discover hidden gems. These stocks may not be flashy or popular, but their fundamentals often show great promise for long-term growth. Finding non-barbers takes patience and a keen eye for detail. Take, for example, companies in niche industries or with temporarily undervalued assets. These are the companies that may not fit into the mainstream narrative but offer a great opportunity for those willing to dig deeper. One famous example is Apple in the late 1990s. At the time, many investors were skeptical about the company's future, but those who believed in its potential were rewarded handsomely. Investing in these overlooked stocks doesn't mean just picking any random underperformer. Like the Barber Paradox, it's crucial to apply sound reasoning. Look for companies with strong fundamentals, solid cash flow, and the ability to weather economic downturns. Don't be swayed by the crowd. Instead, focus on the true value hidden beneath the surface. As legendary investor John Templeton said, the time of maximum pessimism is the best time to buy. For value investors, identifying the non-barbers is about looking where others aren't and finding value in places that aren't immediately obvious. Chapter 6. Breaking the Paradox, a value investor's road to clarity. The Barber Paradox challenges our ability to think logically and make decisions based on clear reasoning. But in value investing, clarity is essential. To break free from the paradox and make successful investment decisions, value investors need to stay disciplined and focused on key principles. The first step in breaking the paradox is avoiding the trap of short-term thinking. The stock market can be unpredictable in the short run, and prices often don't reflect a company's true value. By focusing on long-term trends and fundamentals, you can avoid getting caught up in the noise of daily market fluctuations. One key principle is focusing on a company's intrinsic value, which is the true worth of the business based on its assets, earnings potential, and growth prospects. This requires a detailed analysis of financial statements, management, and industry conditions. Research from McKinsey & Company shows that companies with a strong focus on fundamentals outperform their peers over the long term by a margin of 2 to 3 times. Another important aspect of breaking the paradox is learning to trust your own analysis. Value investing requires confidence, especially when the market seems to be going in the opposite direction. It can be difficult to go against the crowd, but staying true to your research and avoiding emotional decisions will help you make better choices. Finally, successful value investors know when to exit a position. Just as the Barber Paradox suggests an endless loop, holding onto a losing investment can trap you in a cycle of losses. Knowing when to cut your losses and move on is a crucial skill in value investing. Warren Buffett sums it up perfectly when he says, "The most important thing to do if you find yourself in a hole is to stop digging." By focusing on long-term fundamentals, maintaining confidence in your analysis, and knowing when to move on, value investors can break free from the paradox and build a successful portfolio. Clarity, discipline, and patience are the keys to navigating the complex world of value investing. Don't forget to subscribe for more valuable insights. Stay tuned for even more tips to help you succeed in the world of investing.